Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Looking at this market, we can view the whole action from the heights of March all the way down until 5 weeks ago as a large bearish halfway hesitation, with a target X below in the 2030 area. It was one of the most gratifying moments in recent times for me to see prices drop down to reach target X in mid-May and immediately shoot back up again. The subsequent juddering rise pushed up through. Now, these are in no particular order. They are the congestion at 2132 to 35, the extension of the lower trend line for the May to June 2021 descending triangle, and that's currently at 2147, the middle time currently 1952 of the March to April bearish shift pitchfork, and pushed up through but did not close over the 50% Fibonacci line of the June to October 2018 move at 2221. It was a combination of this 50% Fibonacci line and the upper time, currently 2168, of the March to April bearish shift pitchfork that capped this rise. We saw prices drop down such that we are currently within a fairly free area between the previously mentioned 50% Fibonacci line overhead and the old target X below. This recent move, initially up and then back down, has validated the bearish shift pitchfork, or at least the downtrend line that was coincident with the upper time. So what's next? Well, I'd like to reprise two separate and somewhat lagging indicators. They are: one, in May, the dead cross of the short medium moving average, currently 2233, dropping down through the slowly declining medium moving average, currently 2273. And also two, the short medium moving average dropping down through the long moving average, currently 2278. The special reason to reprise these two is that these two lagging indicators have been joined last week by a third, more powerful one. The declining medium moving average moved down through the long moving average. Of all three, this one is perhaps the most important. This now brings me to potential patterns, and we may have one of these two. Either another bearish half hesitation in the offing, much as we've seen in March and April, or a possible double bottom. It is still too early to say which, but it's worth noting both these possibilities for the future. While we are waiting, I'd like to further nurture an idea I planted in your mind 4 weeks ago, and I've repeated it ever since. It is to regard the whole action of 2022 so far, as even perhaps going back to November of last year, as a possible diamond pattern. This idea is still way too early, but you may hear more on this should it develop in the future. LME 3-month tin. The move down below the flatlining long moving average, currently 39060, back at the start of May, for bearish opening long black Mariposa, was the market finally making its mind up on what to do with the inverted cup with handle pattern formed between March and early May. The end of that early May move by the middle of the month exceeded any targets on the downside as prices pushed down through a fairly free zone from under the long moving average down to the two congestion zones below. The first and smaller one is between 33,665 and 33,475, containing the April 2011 previous all-time high of 33,605. The second larger congestion zone between 31,845 and 32,985 contains the 50% Fibonacci line of the March 2020 to March 2022 move at 31,845. In effect, the first zone slowed the drop, whilst the second zone finally halted the fall. The fall fulfilled the downside target, unlabeled it was so close, of the mid-April to May bearish halfway hesitation and the inverted cup with handle pattern for the March to start of May action. Thus, all downside targets were at that time filled by this market's drop. Subsequent reactionary rise through May and into early June was muted, as though prices broke the then March to date downtrend, currently at 34,125, they failed to exploit the break. 2 Fridays ago, we had the consequence as the market reverted back down with an immediate countering bearish opening long black Mariposa. This downtrend has now been reassigned. Monday and Tuesday last week had a follow-on to that Friday's action, but with Wednesday to Friday of last week, we had the resurgence, a delayed resurgence, if you like, but still a resurgence from that second larger congestion zone between 31,845 to 32,985. But last Thursday, you could see that the delayed resurgence had managed to hold a bearish incentive only so much, only just so much, as we made an indecisive doji cross that day. Last Friday started to move back down, but interestingly, yesterday's action was making a new low, one not seen since June last year, still made a hammer pattern, a pattern that is usually seen as a bullish pattern. I suspect that this may be the opportunistic work of the congestion at 31,255 or those lower at 3250 or 29,005. Nevertheless, these actions below the 31,845 to 32,985 congestion zone have opened up some possibilities. Firstly, I drew last week a rather acute bearish Andrews pitchfork for the mid-April to early June action. It is very acute and therefore likely unsustainable, but it does give an idea of what we're maybe looking for on the downside. Right now we're between the middle time below, currently 27,985, and the upper time above, currently 34,015. It also allowed me to pose a question, is this action since mid-April a possible bearish halfway hesitation? And the answer is looking like a yes. If we do regard this as a possible bearish halfway hesitation, then the potential target X for this move would be in the 26,000 area. I'll let that sink in for a moment. That is a big move and something you all should very much consider. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.